Good afternoon. Thanks for joining us today. My name is David Judas, and I head up the Intermediary Sales and National Accounts team here at Barron Capital. And today we'll be discussing the first quarter for the Barron Asset Fund and Mid-Cap Growth Strategy. And we're lucky to have our co-CIO and Portfolio Manager, Andrew Peck, here today. Hey, Andrew, thanks for joining us.
Good to be here, Dave.
If you're going to have any questions today, please type them into the Zoom control panel box or send them to questions@barronfunds.com. And we'll do our best to address them either on this call or with a follow-up from your Barron salesperson. So now I'd like to kick it off. Andrew, perhaps you could share your perspective with us for the first quarter.
Sure, Dave. Well, it was clearly a strong quarter for the market, driven primarily, I think, by signs that inflation is moderating and the general belief that lower inflation will lead the Fed to reduce the pace and magnitude of its interest rate hikes. Consistent with this view, the 10-year interest rate fell 40 basis points in the quarter. In March, there was a concern that Silicon Valley Bank and Signature Bank failures would lead to a contagion across the financial sector that clearly caused a short-term dip in the equity markets, but they soon recovered. I think really the big story during the quarter was that the market was reacting to the possible end of the rising interest rate cycle we've been in for over a year by adopting a risk-on posture. In this risk-on market, high growth, high beta, more speculative stocks, which had generally fallen the farthest in last year's bear market, seemed to recover the fastest. Sectors like information technology, communication services, consumer discretionary were particularly strong, and more defensive sectors and companies trailed. It was not an ideal environment for Barron Asset Fund, at least on a relative basis. Barron Asset Fund favors high quality, competitively advantaged, more predictable growth companies. I think as a result, the fund tends to lag in the early stages of a rapid market recovery. This was similar to our experience in 2009 in the aftermath of the financial crisis. But you can refer to our shareholder letter for more specifics on the quarter, including contributors and detractors.
Okay. Great. Thanks, Andrew. Looking through the portfolio, you had a few very interesting additions this quarter. I see in energy and biotech sectors. Maybe you could share with us what's going on in those spaces that make Quanta and Repligen particularly attractive long-term ideas.
Sure. So Quanta Services is the leading specialized contracting service company for the utility and energy industries. Basically what that means is that Quanta is the leading company working with utilities and alternative energy producers to physically build out and upgrade their distribution and production assets. Quanta should be very well positioned to benefit from the substantial investment that will be going into the utility sector throughout the coming decades. Investment in the electric grid is needed to both upgrade aging infrastructure, increase its reliability, and to connect it to sources of renewable energy like solar and wind farms. And I would say in particular, the widespread adoption of electric vehicles will require substantial investment back into the distribution grid. The recently passed Inflation Reduction Act should accelerate these trends, and the IRA, Inflation Reduction Act, gives us more than a decade of visibility into grid-related investments. Lastly, in order to meet the net zero goals that governments have laid out by 2050, global energy transition spending needs to triple by 2030 and expand again thereafter. In the case of Repligen, Repligen supplies various tools to the bioprocessing industry. This means that the company makes tools that are used in the complex production processes for biologic drugs. Repligen's markets include upstream cell culture, downstream chromatography and filtration, and process analytics. Repligen operates in attractive, fast-growing end markets. Historically, the company targeted the monoclonal antibody market, which is growing around 10 or 12% a year. And it's expanding its presence into the cell and gene therapy market, which is growing in excess of 25% a year. Bioproduction is a highly regulated industry, and so as a result, tool suppliers like Repligen become tightly embedded into client workflows, and their products are rarely removed from the production process. We think the company is well positioned to benefit from the wave of new biosimilar drugs that's expected after key biologic patents expire starting next year. And we see the opportunity for Repligen to drive an attractive recurring consumable stream in an increasing number of commercial biosimilar production processes. The company has laid out a long-term goal of achieving 20% revenue growth throughout at least the next 5 years and achieving EBITDA margins of in the neighborhood of 30%. We think Repligen is a high-quality compounder with a best-in-class mix of both growth and profitability.
Sounds really interesting. Thanks, Andrew, for that. We don't invest much at Barron in regional banks. We did have some exposure to First Republic, and as long-term investors in Schwab, which was recently, about 2% of the portfolio. I thought it would make sense to ask you about, comparing and contrast what happened in those stocks during the quarter.
Sure, Dave. So First Republic Bank was a long time, actually successful investment for the fund. Although, as you mentioned, we rarely invest in traditional banks, First Republic was a bit of an exception because the bank had a unique niche in our view. The bank was focused on attracting high net worth clients in select geographies by offering superior differentiated customer service, and it then cross-sold those customers various financial services, including wealth management. The bank had virtually no credit losses because of its carefully screened customer base. We bought the stock back in 2010 at around $25 a share. The fund then sold a bunch of stock during the 2019 to 2022 period at prices between roughly $80 and $180 a share. But then earlier in the past quarter, we sold our remaining position in the aftermath of the Silicon Valley Bank failure, which was really prompted by a loss of confidence in that bank that led to a classic run on the bank. And First Republic's share price began to collapse shortly thereafter because investors feared that First Republic could face a similar fate, largely because the majority of its funding base was comprised of large uninsured deposits. And many of these deposits were, in fact, withdrawn from First Republic following that high-profile turmoil at Silicon Valley, to a lesser extent, Signature Bank. These deposits would likely have been replaced with higher cost funding, leading to significant earnings pressure on the bank. So we concluded that the bank's competitive position and earnings potential had been permanently impaired, and we exited the position earlier in the quarter, as I mentioned. And the recent news about its sale to JP Morgan, I think, validated our decision to sell. In the case of Charles Schwab, which also declined following the failure of Silicon Valley Bank, we remain shareholders, as we have for a significant period of time. The key distinction, in our view, is that we don't believe Schwab has any risk of a potential solvency issue, or as I phrased it earlier, a run on the bank. Really, despite running a much different business than Silicon Valley Bank, Schwab does face some near-term deposit pressure through what's called cash sorting in the wake of the bank collapse. Basically, what that means is that as interest rates have risen, some Schwab customers have moved some of their uninvested cash balances into higher yielding money market funds. As cash balances decrease at Schwab, the company may need to raise short-term external funding, which is more costly to Schwab than the customer cash balances being depleted. This trend results in pressure to near-term earnings estimates, and I think contributed to Schwab's recent share price weakness. Nevertheless, we do retain long-term conviction in the value of Schwab's franchise. Most important, in our view, is despite the dislocation that we've experienced in the financial system over the last couple of months, Schwab actually saw accelerating near-term net client inflows during the first quarter, during which they gathered over $130 billion in net new assets. Schwab has roughly 34 million customer accounts. The average cash balance in those accounts is in the neighborhood of $15,000, so very meaningfully below the $250,000 FDIC limit that we've heard so much about lately. We remain very much encouraged by the firm's holistic client relationships, its robust organic asset growth, and its industry-leading operating expense per client asset. Schwab remains well-positioned to retain its client assets and to increase its long-term earnings power, in our view. So we remain shareholders.
Oh, that's great. Thanks, Andrew. Moving on to looking at the last couple of quarters in the market's been strong. Would you think now's a favorable time to invest in growth and mid caps in particular? We'd love to hear, your perspective on valuations.
Sure. Well, as you said, this was the second consecutive quarter of strong performance in the equity markets, and it was also the second quarter where growth stocks have generally outperformed. But still, the primary mid-cap growth index has underperformed the primary mid-cap value index by about 550 basis points compounded during each of the past 3 years. So there's still a long way to go for mid-cap growth stocks to make up ground that they've lost recently to value. And then in addition, mid-cap growth stocks as a group are now trading at a discount to their long-term average price-earnings ratio, which historically has been a compelling sign for future outperformance of that asset class. As I mentioned earlier, growth stocks are the types of stocks that typically perform best when future interest rate expectations moderate, as they currently are. And this is because they have a disproportionate percentage of their earnings and cash flow expected far in the future. Initial outperformance in the sector typically comes from more speculative businesses with less proven abilities to generate significant cash flows. But as the market continues to recover and the economy stabilizes, we expect the types of companies that Baron Asset Fund favors to assume market leadership. And these are leading companies in their industry that benefit from secular growth drivers, strong competitive positions, and exceptional management teams.
Great. Let's take a closing look with your outlook. Maybe, given recession concerns, the rate concerns you've mentioned, what are you hearing though on the ground with your companies, and how does the growth and earnings outlook kind of shape your view of, go forward?
Well, as everyone on this call likely knows, we don't utilize a top-down macroeconomic view in making our stock selections. With that being said, the messages we're hearing back from our companies are consistent with the view that investors have been overly pessimistic about the outlook for the U.S. economy. Demand has generally held up, and business trends that may have been artificially inflated by changing consumer and business behavior during the pandemic have generally normalized. Inflation pressures in their businesses seem to have peaked, and we're hearing that they've been able to exercise an appropriate amount of pricing power to offset cost pressures they faced stemming from supply chain issues and labor market inflation. IDEX, for example, is a longtime holding in the veterinary diagnostic space. Veterinary visits spiked during the pandemic, which created several quarters of very difficult comparisons for IDEX, but those comparisons have now normalized, allowing revenue growth to accelerate. And at the same time, IDEX was more aggressive with its pricing, helping to grow revenues and maintain its margins. And as you know, many of our investments benefit from secular trends. And what we've heard from management is that those trends have not been meaningfully derailed by any of the economic issues you alluded to. So at a company like IDEX, people continue to adopt and care for their pets. At a company like Gartner, which provides research on the information technology sector, businesses still need advice when grappling with how to respond to ever fast-moving technological changes. In the case of a company like West Pharmaceuticals, which makes packaging for a wide range of pharmaceutical and biologic drugs, West continues to benefit from more drugs being approved and sold, including the new class of injectable weight loss drugs we're all reading so much about. So I think the bottom line is that what we're hearing back is bullish for our types of businesses, particularly against a backdrop where growth stocks have lagged and their trading multiples remain below their long-term average.
Okay, Andrew, thanks so much. That's really helpful. And that concludes our conversation for today. I'd like folks to visit baronfunds.com for replay information. on this and our other PM webinars. And I want to thank everyone for joining us. And of course, thanks for investing with us. Thank you.
Thank you.